We're going to stick with the Federal Reserve now, and the central bank voted to put new restrictions on the U.S. banking industry after its latest round of stress testing. It capped dividends and banned buybacks until at least the fourth quarter. Yahoo Finance's Brian Chung is here to discuss. So, Brian, what did the Feds find in this analysis?
Well, the Federal Reserve does these stress tests every year, but what's unique about this year is that in addition to the severely adverse scenario that they usually incorporate into these stress tests where they make sure bank balance sheets look healthy to sustain something like that, the actual situation that we're facing in the real world is worse than what the Federal Reserve had provided in its severely adverse scenario when it announced the stress tests earlier this year. So what does the Federal Reserve do? Well, they added what they call a sensitivity analysis, where they were taking projections over what they would say would be a V or a U or a W-shaped recovery and make sure that the nation's 33 largest banks can actually withstand the shock. Now, what the Federal Reserve found was that for the regular stress tests, all of the banks that were tested did meet regulatory minimums, but that under the sensitivity analysis, that COVID-19 specific analysis, several firms would reach minimum capital requirements, which definitely was a concern. That's why the Federal Reserve, as you mentioned, put in these restrictions on, first, no share buybacks for the third quarter, and then secondly, capping dividends. Banks can still pay dividends, but they will not be able to either increase dividends compared to the last quarter or pay out more than what would be the average of the last 4 quarters of income earned. So this restriction, again, does not restrict banks from actually paying out capital to their shareholders. That's something that Lael Brainerd, the Fed governor, had actually dissented from. She was asking the question, why allow banks to issue these dividends anyway? But ultimately, the other voters on the board were overpowering in getting this specific proposal passed. As you see on Wall Street right now, a lot of these banks not taking it well, despite the fact that the overall broad markets are down. Goldman Sachs down almost 4% in pre-market trading. JP Morgan Chase and Bank of America over 2%.
And Brian, any banks stand out to you as being notably weak?
Well, the sensitivity analysis interestingly aggregated the bank industry. The Federal Reserve said it did not want to use that sensitivity analysis and then publicly disclose specifically which banks were going to come close to regulatory minimums. But the regular stress test results did unveil firm by firm basis what the results of this test were. A number of firms, again, were close to regulatory minimums. None of them fell below those regulatory minimums. Keep in mind, banks can no longer pass or fail this test. But as you could see from the trading, Goldman Sachs, JP Morgan Chase, Bank of America, which rely heavily on those dividend payments, are definitely companies that are being watched specifically by Wall Street because of this dividend cap.
All right, Brian Chung, thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.